With this basic crypto day trading strategies, you will discover how to profit short-term price movements. Hey everyone, this is Clever Money, and on this channel, we love talking about methods to make money while you are online. We are going to discuss day crypto strategy today. Before we begin, don't forget to subscribe to our channel and switch on our notifications if you haven't already so you don't miss any of our stuff. With that out of the way, let us get started. Day trading is an investment strategy that makes money by making multiple trades of one or more securities throughout the day. While traditional buy and hold investors are focused on companies' long term performance, day traders are looking for more immediate profit chances. To profit from short term price changes of stocks, bonds, and other commodities and currencies, skilled day traders use a variety of resources and tools, such as stock screening or trading simulator software. Day trading is a challenging process that involves attempting to profit from price differences and fluctuations in a short period of time. The risk connected with day trading is substantial. The crypto markets have recently become a more popular location for day traders. Crypto markets, unlike traditional markets, never close. Day trading cryptocurrency does not require a brokerage or margin account, making it easier to engage in short term trades than on the stock exchanges. Cryptocurrency is a new and fascinating market, but it comes with hazards for people who want to invest in it. With thousands of new cryptocurrencies appearing on exchanges and trading platforms every day, anyone thinking about investing in a cryptocurrency should be aware of the market's volatility and speculative character. A day trader should have a full understanding of crypto as well as trading concepts, regardless of the market. Only put your money where you are willing to lose it. Here's all you need to know to get started day trading crypto if you have immaculate risk management abilities and steely nerves. The first decision a day trader must make is which platform to employ. Only nationally regulated crypto trading platforms are available to US traders. Therefore, this is an important issue to consider while looking for the right platform. When it comes to choosing the best platform to buy and sell crypto, exchange liquidity, asset liquidity, and fees are at the top of a trader's list. Because of the erratic nature of the cryptocurrency market, the value of digital assets can fluctuate dramatically. Traders who want to maximize their profits in this market must act quickly. When deciding where to conduct cryptocurrency trading, the first option isn't always the best. The possibilities and distinctions among the several crypto exchanges can be bewildering for beginners to the crypto market. When looking for the right trading platform, keep the following factors in mind. First is the years in business. The longer an exchange has been in operation, the more stable and credible it is. Second is supported cryptos. Knowing which cryptocurrencies are available to trade ahead of time can be a useful tool when deciding which platform to use. Day traders interested in altcoins may find a smaller exchange with more supported cryptos and trading pairings to be more useful than a larger exchange with fewer possibilities. Third is transaction costs. Transaction fees are the fees charged by exchanges when buyers and sellers execute a trade. To monetize their business, all Bitcoin exchanges charge users a transaction fees. The transaction fee structure can vary depending on the exchange's strategy, such as charging to fee for trades over $10,000 to encourage large scale trades. Fourth is deposit methods. Users must fund their exchange account with capital similar to brokerage account. Many exchanges accept bank transfers and wire transfers, but fewer accept credit card funding, PayPal transfers, and even gift card transfers. Fifth is the user reviews. One of the best ways to evaluate which exchange to choose is to visit different crypto communities and read user feedback. Sixth is liquidity. Liquidity refers to an exchange's speed and ease of converting one asset into another without affecting its price. The top cryptocurrency exchanges are highly liquid, which means they can purchase or sell assets very instantly and with a small spread between the bid and ask prices. A number of internal factors have an impact on exchange liquidity. High trading volume for the listed crypto assets, the amount of active traders on a specific exchange to fulfill orders, cheap fees to encourage makers to open positions, and a range of funding alternatives to attract new traders to the platform are all factors that contribute to the platform's success. Another consideration for prospective traders is whether the exchange of their choice makes it affordable and simple or even possible to transmit their assets off platform to another crypto wallet of their choosing. Your exchange should make it simple to send account funds or assets to off platform wallets if your day trading is cut short. After you have set up your account on a platform, it is time to decide what you want to invest in. Market volatility is a necessary evil for crypto day traders. The same market instability that scares away buy and hold investors, also creating possibilities for day traders to benefit. Consider asset liquidity, volatility, and trading volume when deciding what to invest in. Once all is done, you will need to decide on a trading plan. Day traders employ a variety of strategies to profit from short term changes in the crypto markets. A crypto day trader should develop a profitable strategy based on research and have well defined plans for entering and exiting positions. Certain websites allow aspiring day traders to track and mimic the most successful traders on the platform. Arbitrage in cryptocurrency is when a trader buys a cryptocurrency on one exchange and instantly sells it at a higher price on another exchange. Arbitrage opportunities can be facilitated by cryptocurrency pairs. Arbitragers can benefit by taking advantage of the value difference when the price of a crypto pair consisting of a lesser known altcoin and Bitcoin varies from one exchange to the next. While arbitrage is a complex financial technique that is typically automated by price monitoring software, it keeps the prices of digital assets consistent across exchanges. Bot trading is the next strategy. A trading bot is a software application that allows investors to purchase and sell financial instruments at a predetermined time or when certain circumstances are satisfied in order to optimize earnings. Crypto trading bots are intended to boost profits while lowering losses and dangers. Crypto trading bots can speed up the process of analyzing price changes, exchange fees, and potential to benefit from deals in the near term. Bot trading software has been a feature of stock exchange brokerages for decades. Traders that are familiar with software development and APIs should consider using this knowledge to their advantage as day traders. After that, there's a long straddle. The long straddle, also known as the buy straddle, option straddle, or simply straddle, entails buying both a put and a call order. In a long straddle, the call and put orders are on the same cryptocurrency, strike price, and expiration date. Because of the volatility of the crypto market, a long straddle is a popular strategy in crypto trading. This approach involves a crypto day trader betting on the price of a crypto asset changing. In the long straddle, the day trader makes money whether the price increases or falls. The trader will lose money if the price does not move. Range trading takes advantage of sideways or non-trending markets by identifying consistent high and low prices, which are depicted as resistance and support levels on charts. Day traders that use range trading tactics choose a period of time when a crypto asset is oversold at a low price and sell it when it is overbought at a higher price in order to profit. Online skinners can help crypto day traders to find the proper crypto assets to range trade. Range trading, like the bulk of other trading strategies, can be used in markets other than cryptocurrency. Range trading is used by crypto day traders because it has clearly defined entry and exit points, which can reduce losses. The range trader minimizes losses caused by negative news cycles or market circumstances by making small profits over a short period of time. In our last video, I went over the scalping method in great detail. So if you haven't seen it yet, I strongly advise you to do so. In any case, scalping is a trading method that takes advantage of enormous volumes of liquidity to profit from minor price swings. Buying and selling bitcoins or altcoins over the course of a few hours and cashing out on minor percentage gains at the end of the day, or setting up a bot for high intensity and frequent transactions based on signals or technical indicators are examples of this investing approach. Scalping cryptocurrency is popular among day traders because of its simplicity of automation for bots, low risk, and potential reward. Trading bots can reduce the anxiety and tension associated with trading. Scalping allows traders to analyze their wins or losses at the end of the day rather than investing for the long term because the positions are smaller. Because of market volatility, traders can consistently earn small profits over time, which can add up to significant returns in the long run. Technical analysis is the next strategy. The study of financial data such as past price and volume data points to uncover statistical trends in the market is known as technical analysis or TA. Many people argue that crypto is incompatible with technical analysis due to the lack of worldwide laws and large number of exchanges. Others feel that metrics such as the Relative Strength Index (RSI) are useful. The RSI indicator assesses the relationship between the price of cryptocurrency and its actual demand. The RSI can help traders map entry and exit points based on the momentum by determining whether an asset or security is overbought or oversold. So guys, that is it for today, and I hope you learned something from this quick video. If you liked today's video, don't forget to like and subscribe using the buttons below, as well as the bell symbol to be notified when there is a new upload. I'll see you all again next time, and please remain safe.